My name is Ron Chakler with American Portfolios Financial Services and American Portfolios Advisors. In my 28 years as a financial advisor, my job has always been to guide clients in making sound and informed decisions with regard to their investment portfolios. This is the first of a series of videos which I will be presenting to help you make some sense of the tumultuous times we are facing today and how we should plan for the future. This year, more than ever, has created an unprecedented situation that makes prudent guidance more important than ever. The crisis that has swept the financial markets this past year, beginning with the collapse of Bear Stearns, the government bailouts of Fannie Mae, Freddie Mac, and AIG, and the bankruptcy of Lehman Brothers, will no doubt change our financial landscape in the future. I believe there are many factors that had to have come together to create this financial crisis. While it is very easy to just blame the fat cat investment bankers who got very, very rich during this period, there's a complex web of blame. Let's look at some of the other factors which I think contributed in creating this situation. Let's start off with the deregulation and the repeal of the Glass-Steagall Act in 1999. This act, which was in existence since 1933, kept commercial banks separate from investment banks. Repealing this act under the Clinton administration allowed commercial lenders to, in a sense, deregulate the financial markets and to package securities which have come to be known as CMOs and CDOs, which is the basis for most of the failed securities resulting from the housing boom, then bust. The Federal Reserve Board also has had its share of blame with the unusually low borrowing rates they created. This increased the excess liquidity in the system, which helped to inflate the real estate bubble. Fingers have also been pointed at the SEC for not banning naked short selling and abolishing the uptick rule, which had a negative effect on the stocks of many financial companies this past year. And how about the role that our Congress played in pressuring banks and mortgage lenders to make more mortgages in low-income areas, where borrowers would normally be rejected as bad credit risk, all in an effort to increase home ownership in our country. Just check out the Community Reinvestment Act of 1977 and all the changes made thereafter. Then there are the rating agencies who were unable to accurately analyze and rate these complex derivative securities that were produced by Fannie, Freddie, and the other investment banks. And also our accounting rules that forced banks to value securities as worthless just because no one wanted them in the panic that ensued. So now that we understand how we got into this mess, I am quite confident that the recent government intervention known as the TARP plan, the Troubled Asset Relief Program, will help boost our economy for a number of reasons. First and foremost, all the banks involved will now have fresh capital. Secondly, they can raise new debt more easily thanks to loan guarantees. And finally, because the U.S. government is now a major shareholder, it is even less likely that the government will let one of them fail. This should help the credit crunch, which has basically caused lending to come to a screeching halt. And as we all know, credit and lending is the cog that keeps our economic wheel going. Our next video will examine volatility and how it relates to the stock market. As always, please respond or call with your feedback on other topics you'd like to see addressed in future videos. Thank you very much for watching.